Hello and welcome back to Everything Algo Trading. I am Robert. If you've been following this channel, you know that I use a lot of negative reward to risk ratios and I do a lot of statistical analysis. That's what this video is going to be about. So let's get straight into the details. And as you can see on the screen, I have a table on my VPS where I have been testing several different strategies against eurgbp with a wide range of take profits and stop losses. The test is nowhere near complete, but what we are looking at is a clear representation of some very interesting data. If you followed my cryptocurrency test with ADA USD, then you already have an idea of some of what I'm going to present here. But this is specific to the Euro GBP data and backtesting history. 23 years of history have gone into each one of these tests. So let's get into it. Looking at the numbers, 0.2 is roughly 20 pips, or 0.3 is roughly 30 pips. It is 0.2% take profit, stop loss, in that order. So as we look at the screen, we can see the channel of which I have created this test, stepping through each series. Now this particular chart is sorted by P&L, or profit and loss. So let's get to some of the more interesting details and eventually the profits or losses of this strategy. But before we move the screen, I want to point out something very specific. Bollinger Band's parabolic SAR was one of the best strategies with ADA USD. And ironically, here in Euro GBP, it is one of the worst. So now we are moving the screen to the right, and we can see the sells, the wins versus the losses. And then on the extreme right, it will be the P&L when I get that far. But we can see clearly that the losses in many cases are very substantial. There are a few cases where the wins are actually more than the losses. For example, this particular one where we had 923 wins and 919 losses. Almost a 1-for-1 ratio, but it is still in the losing side of the trades. That is important. And we can even see down lower on the screen where we actually have a 2-to-1 win ratio. That is, we won literally 2 trades for every 1 losing trade. That's a fascinating little turnaround. And yet, it lost money. So even though we had a positive win rate, it still lost money. Let's go see if we can find the take profit stop loss for that. 0.2 to 0.7. So even though this is a negative risk to reward, the gapping is too large. And that is important. If you have a negative risk to reward, you can still have a gap too large for your asset. And that will mean that your losses will overshadow any of your profits. So this isn't just picking a random number that might be a huge drop before you cut your losses. You need to test the asset. Find the best place for the asset and then go from there. Every single asset on the market is different. This isn't about one system working across the board. Every single asset you use must be tested. It must be analyzed. You have to make sure your trading strategy works with the asset. That is one of the biggest mistakes I see in trading, is people will take a particular strategy, and just because it worked on Euro USD or ADA or XMR or whatever, they'll simply apply that strategy across the board to everything. That usually doesn't work. And that's the problem. It usually does not work. You have to be careful and test. For example, if we look at the bottom of the screen, 442 wins to 133 losses, and it still overall lost money. What was the risk to reward for this one? This is a 0.2 take profit to a 2 stop loss, an extreme range that caused a 3 to 1, roughly almost 4 to 1 win rate, but still lost a huge amount of money. This win rate is phenomenal. A 4 to 1 win rate. That is impressive, but it's still a loser. So as you consider your metrics, your testing, always run these kinds of back tests, these kinds of analysis, because they are important. They are significant. So let's keep going and see where this leads. Let's see if we can figure out where we actually start making positive profits. And as we continue to look through the chart, we can see quite a few high win rates versus loss rates. So when somebody says they win 4 out of 5 trades or 3 out of 5 trades, that does not mean that they are profitable. Here's an interesting situation where the particular strategy we are using is so restrictive that it doesn't meet any criteria in this particular trading. Parabolic SAR Rule 37. This is a surgical strategy. For this particular market, eurgbp, it's not volatile enough to trigger. That is fascinating. And that is an important situation to be aware of when you are looking at your trades. But this is the perfect example that some strategies just don't work well. In the cryptocurrency market, this strategy on the right asset can be a home run. Here, it's a disaster. Okay, buy and sell. Now this is an interesting approach, and it's also a positive approach. Buy and sell is an always-in approach. That is, it buys at whatever take profit stop loss, it sells it, and then it buys back again. It's constantly in motion. And you can see from the numbers that it has a huge turnaround by just following the market. The path of least resistance. In the cryptocurrency market, the buy and sell strategy is a hot, stinking disaster. You will literally destroy your account using buy and sell in the cryptocurrency market. But here, buy and sell on just about every single take profit stop loss is reasonably profitable. Now again, this is 23 years of history. So I wouldn't say it's something you really want to do. You've made money, but only $2 out of 23 years with 1 unit at a time. Now if you did 10 units, then you would have $20. If you did 20 units, then you would have, if you did 100 units, you would have $200. So you can see how you can extrapolate, but you need to be aware that even though this is profitable, it's probably not the best way to go. But still, that is impressive that buy and sell on just about every style of take profit and stop loss for this asset was remarkably profitable compared to ADA USD, which was a complete and total failure. We keep going, and we see Bollinger Bands RSI, a 3-candle support resistance ATI, and just a simple support resistance ATR. And they are also profitable. Now let's look at the take profit stop losses. Now we begin to see the pattern here where a 1-to-1 or a negative risk to reward starts to really show up. That is, the take profit is less than the stop loss. And we can see clearly the patterns of the most profitable are within this negative risk to reward process. But again, this is the kind of research you have to do with your asset. Just don't blanket trade. Based upon the ADA USD test I did last week, buy and sell would have been something I would have expected to be a loser. But in eurgbp, I am surprised at how well it did. Remarkably well. So you don't and can't say just because one strategy failed on one asset that it's not a good strategy. It has to be tested on any asset you're thinking about. The classic Bollinger Bands RSI is certainly doing a wonderful way as well. We can see it quite frequently. For example, let's look at right here. 279 profits versus 63 losses. That is a 4-to-1 win rate. And it made $2.80. That's good. That's actually exceptional. Is it the best? No. But it's certainly a respectable profit. And the Bollinger Bands RSI technique is something that is almost universal. So it's well respected and traded by many people. And yet we can see it does very well. So as we continue, we can see a 3-candle support ATR and a simple support ATR. Both of them have exceptional win rates. This is a 6-to-1 win-to-loss ratio. This is amazing. And it brought in roughly $3.40 some odd cents from both strategies. Exceptionally done. The one below it, potato harvester, 557 to 71. That's roughly a 5-to-1 win rate to loss rate. So as we continue, we can clearly see a very strong pattern. Let's bring up the take profit, stop losses, and as we watch this column, or I should say columns, the take profit, stop losses are consistently negative risk to reward. Consistently, the take profit is less than the stop loss. You will find a few exceptions, and you will even find a 1-to-1 that does very well. But that is the point of why you must test, why you must take the time to run these experiments. This is probably going to take me 2 or 3 weeks of analysis to get all of these experiments done. But the results are going to be a trading strategy that I can reasonably take to the next level and actually look at in a paper trader to see if it holds up as well there as it is here. And this is using an adversarial technique where even though the spread might be 1.5, I'm using a random range of 3 times that to help put the market against me even more during the back test. Also to simulate the chaos of a live market. So let's get down to the highest and most important trade. The one that brought in the most. Let's see where it sits. Okay, right now that is potato harvester at 0.3% take profit to 0.2% stop loss. That is quite significant. It's very good. It's a slight positive reward to risk ratio. And let's see what it does. It's done $4.63. But if we look at the ones above it, potato harvester in general for this market is a landslide victory. And we can see that just about every result is in the $4 range. And here we have a whopping 4 wins to roughly 1.5, 2 losses. So we can clearly see the consistency of a 2-to-1 to a 3-to-1 on average win rate over loss rate with the potato harvester on the eurgbp asset. Let's go back and look at the take profit stop losses, and we can see consistently that potato harvester is negative. Negative reward to risk on a consistent basis. The bottom two are 1-to-1 and slightly above into the positive risk to reward. And we even see up here with 3 candle ATR, we have a positive reward to risk. But those aren't the rules. Those are the exceptions. And that's the thing to really stand out with your testing. Exceptions are going to happen, but what's going to be the standard? The standard seems to be negative with a high consistency of a 1-to-1. So as you look at your trading strategies and you look at different strategies, test them all against whatever asset you are looking at, because it is important to understand that you need to look at the outliers and determine whether or not they are consistent with all of the data. Personally, if I was to trade this, I would go with a 0.2 take profit, 0.2 stop loss. It's a 1-to-1, and it's consistent with what I see for the overall data. It is within reason of other points of data that I see that are profitable. The most important part, I personally believe, when you are looking at your take profit stop loss ratio, isn't trying to get the highest profit, because that has a limited window, a limited lifespan as markets change. Ideally, the best place to be isn't at the highest profit or the lowest profit. Ideally, the best place to be is somewhere in the middle. Pick the average profit. The average profit is more likely to carry you season over season in the asset, because the market will change. It will go up, it will go down, it will fluctuate. So you're not at the high, you're not at the low, you're in the middle. So we are more likely to have consistent, sustainable profitability. That is, in my opinion, the most important aspect and part of the entire process. Consistency and sustainability. Share your thoughts though, let me know what you think. And if you like this kind of content, please like, subscribe, and share it with others if you think they would appreciate it. Thank you for watching.